Hey guys, welcome to YBR Capital. Yeah, I know I've been out of the YouTube world for some time, but with the lockdown and things going crazy over here, I guess I'm back. And good news is, first, people who don't know me, just a little of background about me. So, I'm Brian, and I'm used to work in private equity for JP Morgan, and then I moved to Facebook before I opened YBR Capital, a seed stage investment firm out in California. And today actually is an interesting day with the lockdown and the virus and everything going on. We actually decided that it's time to take a pause. So we just sold out all our portfolio companies and paid back our LPs. And we've decided to take a break and see how things play out. So now that I have a little bit of time to work on my interesting pursuits, so reviving this channel back, and thank you for watching this. So the way I'm looking at this is I'm not gonna create a very specific channel. This is gonna be something where we're gonna discuss everything. So today is Macro Monday. So today we'll discuss about what the macro picture looks like, what are the key macro drivers, and where we think the economy is going from macro level. Then on Tuesday we're gonna do Tech Tuesday. So that's we're gonna cover something in tech. Then on Wednesday, it's Real Estate Wednesday. We, due to popular demand and seeing opportunities out there in real estate now, real estate has been like on a tear. And for a regular investor, forget the hedge funds and those REOs and ETFs, the regular folks, it was very tough for them to make money in this environment because it was just gone crazy. So we're gonna cover stuff on real estate. If you're a home buyer, if you're a first-time home buyer, mom and pop investor, or high flying executive, everybody's welcome. I think it'll be fun. Then on Thursday, it's gonna be Startup Thursday. We love startups, and we're gonna look at one specific startup or just a specific sector in the startup and see what's going on. A lot of changes are gonna happen, and how you if you want to make money, make money, that's a good thing. But I think just understanding how all the pieces line up together, and how from macro level to the technology behemoths to the startup environment to real estate, uh, and everything in between, we're going to talk on this channel. And then Fridays, it's TGIF Friday. Hey, life is about having fun. So on Fridays, we're gonna do something more interesting, a random topic, conspiracy theory, I don't know. Then Saturday is more of devoted towards personal development. So in California, since I moved here from New York, I met a lot of folks who are in the FIRE movement, that's financial independence, retire early. I find that a very, I will say, uh, a, a, a very interesting and very good goal to have. Rat race is not good for your health after 10 years. So I think that I've personally experienced, and I think fire movement is really awesome. And then Sunday is going to be motivational Sunday. So every day I'll try to come up with a new clip, hoping to keep it less than 10 minutes, short, simple, power pack. So right, so let's get into Macro Monday. So the way I was thinking today is we're going to discuss what's going in the economy, just setting up the stage in three simple steps. So there are three big players: the Fed, the businesses, and the consumers. So moving into the Fed, so this is what's happening with the Fed right now. So the Fed, as you can see, has gone bananas. Rightly or wrongly, history is gonna be judge of that, and I guess we're gonna be here to analyze this. So the Fed increases balance sheet like this has not happened before. You look at 2008 recession highlighted in gray, and then look at now. It is wow. So basically, you are now looking at $6.5 trillion in Fed assets. So this is basically your starting point. Is the Fed is pumping money into the economy to fight the virus and help businesses survive, consumers survive, everybody. So what they're actually doing is, if you look at that, of the $6.5 trillion, let's look at treasuries today. So the total treasury is holding is $3.6 trillion. So what does this mean? So treasuries is basically supporting the federal government. So that's how federal government gets its money. Fed prints the money, gives it to the treasury, and the treasury is basically part of the federal government, and they do the spending. So that's how the government gets the money. So Fed has created $3.6 trillion backed by nothing except the Fed. There's no gold backing it anymore. Goodbye 1971. So they just created a lot of money. So let's just take a step back and look at the trend. So if you look at the recession, they went down, and then it's just QE1, QE2, QE3, QE infinity now. So you can see like this has never happened ever. So a lot of amount of money has been pumped up. So it's $3.6 trillion. So where is this going? How is this playing out in the economy? That's something we will see as we continue watching this. But just this is a snapshot at the point of time. So data is of the first week of April. So overall federal balance is $6.5 trillion. Of that, almost 50%, 3.6 trillion, is treasuries. And of those treasuries, if you dig deep, so the maturity, that is the middle of the curve, 5 to 10 years. So if you look at the treasury curve, so 0 to 5 you can call it short term, 5 to 10 medium term, and beyond 10 years long end of the curve. So the middle of the curve, the 5 to 10 years, you can see this is what's going on. So 2008 happened, then it went up, and Fed's been slowly tapering it down, as you can see. But now after 2019, little hiccups were happening. So the general sense is there was something going on in the economy. So this thing that's going on is not is not the cause, it's a catalyst. So what folks say is bubble meet brick. So this is the pin that's bursting the bubble. So boom, here you go. It's 600 and some change, 650 $600 billion, you want to say. That's 17% of the total treasuries that's out there. Then if you look at the long end, that's beyond 10 years, that has been stable. As you can see, it went up, then it's been sitting, and then boom, like Fed is like, it's like bazooka is on, the money bazooka. So that is 24%. But the real story lies in the short end. So this is the 1 to 5 year. And this is, I think, where the Fed is focusing its attention. So that is 1.4%. So that's almost 40% of all the treasuries out there. And that's $1.4 trillion. And as you can see, this is the most volatile aspect, again, because the nature of the maturity, but also the main focus of the Fed. So what the Fed was doing was, hey, during 2008, it went for 5 year, then it tried to correct the short term, so it upped it, then it went down, but then things didn't work out, up, then it slowly started to unwind this. And then come 2019, problems were starting to arise, and then boom, highest ever. So most of the action that the Fed is producing is in the short term, and that's where the main effect of this treasury buying binge or the money printing is going to have the most effect. So if you are in the market, either a corporate or consumer, and that's what the Fed is trying to do, is make sure that there's enough liquidity in the short term, so the rates will be lower in the short term for the banks, the businesses, and via the trickle down affect the consumer. So that's where we stand with the Fed. Big bazooka, lot of money being printed, but major impact happening in the short end, as you can see here. So that's the macro story, and we'll do this. What I'm trying to do is introduce to some certain steady metrics and charts for us to see, and then once we have this baseline, then we'll visit this every month and see how things are trending. So right now I'm showing you a 10-year view, and that basically gives you an idea historically how things were going and now what's happening. And then maybe next month when we do this after 30 days of more data, we'll shorten the time horizon, so we'll see exactly what's going on now, impacting the economy. But it's good to have a historical reference. So if you come back and want to get a historical reference, you can come back to this video, see where we were, and leave a comment if you want me to discuss these more. But this is just a general overview of what the Fed is doing at the macro level right now. So now we understood the first player in the US economy. Now let's look at the US businesses. So a lot of talk has been there about buybacks and corporate debt. Yeah, it's true. A lot of debt was taken on to do corporate buybacks, and the stocks were inflated. That's a different story and strategy. We'll talk about that down the line. But what I want to show you is, again, this is the macro level. This is the big picture, all non-financial corporate debt. So this is excludes the bank, because banking is a whole different ballgame, and basically the Fed and the banks is now almost the same thing. Basically, Fed controls the banks and gives them free money. They do what they need to do. So what I was trying to do is the second pillar of the US economy will be the businesses. So just look at the debt after 2010. It's been an explosion of debt, and all it goes up, 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 up. So what does that mean? So we have to see this in perspective. So you have debt, but then you have to have sales to support it. So these are the business sales, and you can see that during recession, dot-com recession was really bad. But if you look at from a macro perspective, it didn't really have much effect. Yes, in Silicon Valley where I am, yeah, it was bad. I heard stories. I wasn't here in 2000. 2000. I was in high school, but yeah. But what I heard was you couldn't get a U-Haul to go and get out of Silicon Valley, because everybody was just leaving left and right. It was a mess back then. But if you look at it from a business sales point of view, nothing there. Again, that was more. There was no sales, so I guess nothing happened. But as you can see, as we reached 2008, it fell off a cliff. Even though we hit the recession, it takes time for sales, to have. It's a lagging indicator, because people don't realize that there's orders, there's back orders, and then it just falls off a cliff, and then things starts to recover, and then as you can see, we've been on an upward trajectory. So if you are a CFO, you can justify that debt with the sales that's going on. So that's the story I was trying to say. But it'll be interesting to see how this falls and how much it falls. But last time it went from 1.2 all the way to 900. So that's what like a 20%. Yeah, so this show they're saying GDP is gonna go down by 20%. So this could fall with the lockdown 60-70%. So this is gonna be the real indicator, is that debt sustainable, and how the sales are gonna be. And we're gonna, again, this is for historical perspective, 10-year chart, 15-year chart, 40-year chart, and then we're gonna narrow it down to 1 or 2 years. So then you will see, like, month to month how things are going, and that will give you what the real impact is on the economy starting whenever we open up. And then of course inventories is basically your liability sides, what's going on. Inventories and sales kind of go hand in hand, but it does give you an indication how confident businesses are. So just in time inventory, with given the supply chain issues we're having, are gonna disappear. Like nobody's gonna keep 5 day uh, computer chips on hand, or 10-day toilet paper on hand. Now it's gonna be a much more longer inventory cycle. So it'll be interesting to see how businesses react with inventory with sales down, and how they correct that. But it's always important to look at inventories, look at sales before we talk about debt. So that gives us the picture. The story is debt has been growing all time high, but there was sales to support it, and it could be justified. But let's see how bad things go and how fast deleveraging happens. So if companies deleverage, that affects inventories, that has a downward stream on the suppliers, and the other aspect is employment. Uh, a lot of companies out there take on debt to pay the employees, so that's nothing new. It's in an ideal world, all your sales support your salaries and everything, but their sales cycles are different. Some are longer, some are shorter. So debt is a vital component, and we'll dig into this. Comment down if you want me to create a link between employment and corporate debt. I think that'll be interesting. But I'm here to see what you guys want, and this is fun for me. So just steer away. The more comments you leave, the better I can curate a presentation that helps you understand the world, make money, or just not worry about your job. I understand that. So, yeah. And then, last but not the least, is our consumer 70%. These guys, again, it's kind of the same analysis I want to do. Is I want to look at the consumer first, is how leveraged they are. So as you can see, uh, you know consumer debt is, this is total debt. So the reason I'm putting total debt is you have to understand consumers full picture, because yes, there's mortgage debt, there's auto loans, there's credit cards, there's student loans. But the way the environment is going, mortgage and student loans are a non-factor now, because basically you can uh, student loans has been waived for 6 months, and most likely it'll be waived more with 0% interest. I'm hoping they do a good thing, and even if students are asked to pay the debt, they keep the 0%. There's no need to make money off their backs, and that never made sense to me. I understand the moral imperative of paying back the loans, but why do you need to charge them such high interest? Don't make money off them, especially in this environment. That's my 2 cents of personal opinion, but bigger people are involved. And so here we see that there was a little deleveraging, during 2017, between 16 and 15, but it started up. There was a big deleveraging in the Great Recession, but after that, just all guns blazing, all-time high consumer loan. So let's see how that turns out. But uh, one aspect of understanding the strength of the consumer is how much is the consumer paying towards debt servicing as a percentage of disposable loans. So you can see from what it looks like is so again, this is a ratio. So that's the beauty of the ratio, is it's absolute, in the sense it gives you how much debt you have and how much income you're making. So if your debt goes down and your income stays the same, the thing will go down. If your debt doesn't go up but your income goes up, it goes, thing will go down. So that tells you a story. Is if you go back to the dot-com era, whoa, people were like partying as if it's 99 literally. Then as you can see, the debt service ratio is falling as percentage of disposable income. So what's the story? Why it keeps falling, and then suddenly starting 2000, I will say for 13, it's starting going up. So that's something I found very interesting, and I think that's something I might look into it. And if that's something you think is interesting, just leave a comment, and I'll make a video just specifically for this. So this gives a a big picture view of how consumer debt service payment as a percent of disposable income has been historically, and there was a trend up, but if you look at it historically, it's not in the peak, but total debt is, but debt service payments as a percent of disposable income is not historically very high. So the consumer seems to be in a decent position, either because of income or the debt is low, but that doesn't tell you the numbers. So what I am personally thinking, I'm very interested in going down this rabbit hole, is it seems that the payment terms might be lax, one because of the interest rate, or two because of the length of the loan, and that's why it's less. So we'll look into this, but this is interesting. So maybe it's not an apples to apples comparison, but it's a ratio, so we have to respect the absoluteness of this. And then the last aspect I want to look at it is revolving credit. So this is basically your short-term loans, personal loans, and majority is credit card. So what's going on over here? Credit card all-time high. Great recession, went up, goes down, releveraging happens up. So this is gonna give us the true indicator of the health of the consumer, in my opinion, because with mortgage kind of being stable, you don't have to pay it, you can kick the can down the road. Student loans, kick the can down the road. Car loans, kick the can down the road. But credit card, no, you have to pay that. And another interesting thing is a lot of people are putting a lot of the expenses on this while they're not making any income. So I'm expecting this to balloon, and that will be an indicator that the consumer is not as strong, and this might be the real indicator of the carnage that's going to happen, or how strong the consumer is from cash position, and if those stimulus checks are having the intended effect rather than just keeping food on the table, which I think is the right thing to do given where we are. But that is more, I don't think it can pay the rent for most people, especially in the Bay Area. You can't pay the rent with that. And I think in most high expenses millennium, where the millennium population is concentrated, the rents are so high that you can't use that stimulus money to pay the rent, but at least you'll have food on the table. So net that's a good thing. So hopefully we'll see this. And I was reading that rent collections were like higher than usually. It's like 75 to 80%, but like this time it was 85 to 90%, and a lot of 30% of the people were putting their rents on the credit cards. So that's going to be interesting to see that data point come in. So that gives you basically the full picture. And of course, unemployment is where the money is. So I don't like to look at the unemployment rate and the initial claims. Reason initial claims very volatile. It's the continuing claims that I think make sense. So if you look at it in the Great Recession, there was a slow upward rise, and then it got really the velocity increased, and then things kind of stabilized, and then it's been downward spiral for a long time, and then now boom, like this is like unbelievable. So if you look at it, the baseline where we started 2008 recession and this one was almost the same, around a little over 2 million. This is also almost 2 million, and it went all the way up to 6 million over 2 years, 1.5 year. And this one went from 2 million to 12 million in 2 weeks. So there is the downward spiral of loss of income and issues that's going to happen, and if the jobs come back. So this basically sets the stage for us on Macro Monday of where we are, and starting 2020 recession. I don't know what they're gonna call it, but from what I'm seeing, uh, it's gonna be a tough one. It's not good because there's deleveraging happening with the consumer. That is a given. Then the speculators in real estate, technology, startups, uh, SoftBank, those guys are gonna deleverage. Then the companies have to, deleverage. Sales are gonna disappear. Sales pipelines are gonna disappear. So, but with the Fed printing so much money, where that money is gonna go? In the sense, is it gonna cause massive inflation? Or is it gonna be the repeat of last time where it goes to the bank, stays in the financial sector, assets go up, so the rich will get richer, middle class will get squeezed, and the poor will remain poor. So it'll be interesting, and mm, so that's all I have for today. I hope you enjoyed our conversation, and I look forward to talking more. So see you tomorrow. We'll talk on Tech Tuesday, and I might not do an Excel presentation because this was a very data intensive experience. So that's why I did it in Excel. But I think tomorrow it'll be more fun. So join me on Tech Tuesday. We're gonna look at the tech sector, and we're gonna see where this is going with the virus and how we can navigate the tech sector and maybe make more money. Stock market, we'll talk about it after a week. I have my thoughts about that, but we'll talk about that. Leave your comments if this is as good as you want this to be. So wherever you think we need to go explore more what I've missed, or in general comments, just give me that. Help me make this better, and I'm quite sure this will help you be either a better investor, just have better knowledge, feel good about the economy in a sense that you understand what's going on, and we're just having a conversation. So no question is a bad questions. Comment below, and I'll see you guys later. Thank you for watching. YBR Capital, Brian out.